Hi students, good morning. Welcome back once again. Am I audible? Can you all see my screen? Okay, now before I start, there is one request which I have to make. When I'm asking you any questions, okay, when we are solving together, there has to be some kind of, involvement of your side as well, correct? If there is certain things which I'm asking you to solve and give an answer to me, you all are doing fantastically well with me all this while. You all have been very supportive. I am just requesting you all to keep that support ongoing. Okay, I like when you all answer the questions because you all are correct. It helps you if you can make this little bit interesting. Okay, I want you all to know that you all are paying attention with me and you all are doing the sums along with me, because of course we are doing this practical, marathon. So in practical marathon, my entire purpose is to help you all solve the sums along what I am doing with. Okay, so my only request is that please be attentive, answer to my questions, put it in the chat box, even comment. If anything is say you want to, you can please go ahead, like, share it, comment on the videos. It will help me know where you all need more help. Okay, like somebody has told me that, oh ma'am, please don't go too fast. Okay, now considering this a marathon, is that is why I have this particular speed. Otherwise, I can go at a pace where I can solve one sum and take 30 minutes of your time. But today, your time is very, very precious because you have to study other subjects as well. Okay, so I do not want to utilize your whole time in my subject only. So I am considering that, and the subject which we are solving is a practical one. Keeping both the things in mind, I am keeping a pace where you can get the best understanding with the least minimum time. Okay, and then you can do your own practice. You can go ahead and watch this video once again. You can watch those sums once again if you don't get it in one go, or you can ask me the questions in the chat box. I will be very happy to answer them. Okay, so as I have told you already that today we are going to do consolidation of accounts. It is for 8 marks. Okay, short, like how we did issue of shares. Consolidation of accounts is definite question. Though it may be asked as choice, but even in the choice there is a second question which is on consolidation of accounts for the new syllabus. For old syllabus also there is no such choice. So consolidation of accounts is very, very important. It is a very interesting topic. There is a particular technique of understanding consolidation. Once that is done, any sum can be solved. All right, so we can begin. But before I just begin, okay, so all those who are attending this today and are not aware, this is my marathon on corporate accounting. Okay, and I have already taken one lecture in on Monday, wherein we had done issue of shares with buyback and with also right and bonus shares. Okay, so one very important topic I had covered in on Monday, in Monday's marathon. I have already given you all the timetable. This is for both old and new syllabus. This marathon is going to help you because I will be solving the sums in detail along with certain past exam questions which are in MCQ form. Okay, though they are in MCQ form, they are very much likely to be asked in your exams, which is a proper writing paper. Why? Because there are steps involved in order to get that answer in MCQ. The only difference between your old and new syllabus is that you all are going to tick the correct answer and here you are going to solve it. For ticking the correct answer also you have to solve it in your rough, correct? Only then you will be able to give the right answer. No, you have to solve in the rough. So I will be taking one more marathon on Friday. So this is my second day for accounts. Okay. Now, as I have already shared with you all, I'm sharing it again today. Go ahead and subscribe to the Dream Batch. That is for the minimal cost. It will give you access to all my lectures until the date of the exams. You need an in-depth understanding. You need more practice on a given topic. You want to solve more sums. You want to solve more MCQs. You want to also do my theory alongside. Please go ahead and take up this Dream Batch. Share it with your friends. Share with the people whom you know and help us reach out. Okay. So go ahead and you can take up the Dream Batch. All my chapters are given in detail. So in case you find any of my topic where I'm going a little fast, since this is a marathon, you can go ahead and you can see that same lecture even in the Dream Batch. Cool? Okay. So we are going to begin, as I told you, with consolidation of financial statements, consolidation of accounts. Okay. Everybody ready? So if you come on, take a pen, paper, calci, everything we will need right now to start solving the consolidation of accounts sum. Now, if you all are aware with the method I teach, I do not directly jump to any of the problems. Okay, first we will take the basic understanding of what is consolidation. Okay, what do you mean by that? Okay, so in that case, we are going to first understand the concept for why this consolidation of accounts has come into being. Okay, why do we need this? For which kind of companies is this applicable? Right. So, consolidated financial statements. So now if you all are ready, please hit the like button, and so that I know that okay, I can good to go with everybody is with me. Okay. Now consolidated financial statements. Okay. Basically, when does this come into picture? When we are talking about a holding company and a subsidiary company and its own subsidiary company. Okay. When there is this type of you know structure of the organization where there is a parent company and then they have one small subsidiary within them, the holding company has to prepare two types of financial statements. One is a standalone and one is a consolidated, giving the aggregate total of the assets of the holding as well as of the subsidiary. Okay, so they have to prepare these two types of financial statements. Now, consolidation is just not about adding the assets and the liabilities and showing it in the balance sheet. Okay, it is not about that. It is much more about understanding the cost of control which the holding company has over the subsidiary company. Now, before I begin that in detail, see, I have made a few notes and few pointers for understanding. Okay. Now, what are the important notes? See, holding company. How I will come to know that this company is a holding company? What is the definition as per your Companies Act 2013? Okay, so holding company is said to be a holding company if it has a control over the board board of directors of a company, of a subsidiary company, or it has got a stake of more than 50% in a company, then it will become a holding company and subsidiary company. Okay, so say subsidiary company has got 1000 shares, from which the holding company is holding 800 shares. So 80% is with the 800 shares of the subsidiary company. So here I can say that holding company has 80% stake in the subsidiary company. So the relationship is now of a holding and a subsidiary. Get that kind of control. If I am buying a 50% stake in a company, in a given company, I will assess how much is the worth of that company, how much should I pay in order to get that control. So consolidation is more about the cost of control. You will get these words many times when you will read the theory and when the questions are asked in your exams. Okay, so I will explain your cost of control in a very simple manner. Say holding company buys the subsidiary company, whose net worth, subsidiary company's net worth is 100 crores. What is net worth? Assets minus liabilities. Okay, their net worth. Total assets minus the outside liabilities gives you the net worth of a given company. The worth of that subsidiary is 100 crores. And holding company has paid rupees 120 crores. Okay, so here have the holding company paid extra 20? Net worth is only 100, but I have paid 120 crores. That means the cost of control is 20. It's like kind of a loss, or you have paid extra. Why would I pay extra to get the hold on the subsidiary company? There is some goodwill of that subsidiary company in the market, for which I have paid that extra. So whenever there is a cost of control which is running more than the net worth of a subsidiary, I will say that I have paid towards the goodwill. Okay, so when there is a loss, when the cost is higher than the net worth, cost for holding company is going to be 120. However, the net worth was 100. So when there is an additional cost paid, I will say I will kind of treat this as a goodwill. Okay, from the holding company point of view. Think from the holding company point of view. Clear? Same thing, if the holding company is buying the same subsidiary company who has a net worth of 100 crore, but they have paid only 80 crores for this investment. So your cost of control is now a positive 20 crore. 20 lakhs, okay, 20 lakhs positive. So that is known as a capital reserve, which is known as a one-time profit. We have paid less than the worth of the company. So we have made 20 as a profit. 20 crores as a profit in this organization. It is a one-time profit. We don't get this profit every year that we will transfer it to our P&L statement. It is a capital reserve. Okay, it is like a capital asset, buying or investing in a organization. Understood? Okay. Now, workings which is required. What happens is whenever there is a holding, there is a stake, say of 80% in a company, the balance 20% are known as minority interest. Of course, balance 20% who are left out. 80% is with the holding shares of the subsidiary, 80% is with the holding. So the balance 20% is with the minority interest, are known as minority interest. Now in the questions you will see they will ask you this type of in exams they will ask you this type of questions. Calculate the cost of control or calculate the amount available to minority interest. Okay, they are going to ask you these type of questions only. Even for a the new syllabus where you are writing the entire paper, they are not going to really get into the details of asking you to make the ledgers and go and make a balance sheet, consolidated balance sheet. They don't ask that. What they are more interested is in how you know to calculate this cost of control, or how do you calculate the minority interest. But if in case they ask you also to make a balance sheet, we are going to solve the sums in that manner. Okay, so it is going to give you a practical understanding. When I will solve a sum with the help of the balance sheet, you will be able to analyze it, that oh okay, this is how a consolidated statement looks like. Clear? So how do I find the cost of control and how do I find the minority interest? What happens is, see, in a subsidiary company's balance sheet, there will be something like equity share capital. They will have some reserves like general reserve, profit and loss account reserve, revaluation reserve. There will be all these preliminary expenses, all that belonging to the shareholders. All those items which are belonging to the shareholders. So equity share capital, different types of reserves, preliminary expenses, all this is what the items that belong to the shareholders. So in order to calculate the cost of control and minority interest, simply I will divide it 80% and 20% as per my example right now. Okay. Equity share capital, revaluation reserve, general reserve, preliminary expenses, they are always treated as a pre. Pre means before holding company entered into us. Before the holding company took the shares of the subsidiary company, we treat all these items as pre-acquisition. Okay, pre and post acquisition. So whatever is related to pre, which is already was there with the subsidiary company, they will be taken into account for calculating the cost of control. Whatever is post will go in the normal P&L statement of the holding company. It will not affect in the cost of control because holding has already entered and now that profits have been started. So with that I have nothing to do. I have to know that before I took over the control in subsidiary, what was these reserves or what were those shareholders items available to what I am going to get at 80%. Okay, so equity share capital, I will take 80% as a holding in order to find my cost of control, and balance will go as a minority interest. If there is any revaluation reserve also appearing in the balance sheet, 80% revaluation reserve takes place only of those assets which were there of that subsidiary company. What do you mean by revaluation? The amounts which appear in the balance sheet of these fixed assets. Okay, with the time the value increases. In fact, though there is depreciation, but don't you think there is a appreciation of the value also? Land and building today, the real estate is so expensive because the square meter area rates are increasing as per the government rates. Okay, so revaluation takes place in these companies so that they know that okay, when we do revaluation we come to know the today's value of our asset. So there can be profits, land and building appearing in the balance sheet will be 50, but when you did a revaluation it is coming as 100. So 50 rupees is the profit. So that is a reserve. So you have revaluation reserve, that will be 80% for cost of control and 20% for minority interest. 80 and 20 is the example I have given you. Okay, I am telling you that the holding company holds 80%. Therefore, minority interest will become 20%. It's an example. It can be different ratios, 60-40, 75-25. Okay. Then general reserves are also always pre. So 80 and 20 I will divide that also. Preliminary expenses are those which were there before only the holding company came and took the control. So it will be 80% and 20%. These are all positive credit amounts. Preliminary expense is an expense, it is a debit amount. All these are credit amounts. Okay, all of them. And last is profit and loss account. Okay, so now profit and loss, which is again a shareholders item, it belongs to the shareholders. If it is pre, I will take it as 80 and 20 and finish it over there. But if it is a post, okay, any profit which is made after the holding company came to take the control of the subsidiary company, then I cannot take that 80% and put in the cost of control. I'll take my 80% and put in my P&L. When I'm saying my, I'm talking from the holding company point of view. I already wrote this statement, okay, when we began with this chapter. Correct. So after I came and took control on the subsidiary company, after that whatever profits I have made, I will put it in my normal profit and loss statement. 20% minority interest will take. Only if that profit is pre, before I came, that pre-profit I will divide 80% and 20% and consider this 80 for cost of control. Okay. Similarly, pre-dividend and post-dividend. What do you mean by pre-dividend and post-dividend? Any dividend which is given from the profits that are pre, it will become pre-dividend. Profits used for giving this dividend is important. Date of giving dividend, date of declaration of dividend, date of payment of dividend has nothing to do. You will ignore all those dates. You will see the profits from which this dividend was given. If these profits are pre-profits, then that dividend I will take it into the cost of control calculation. Minority interest will have no effect. It was a pre-dividend, no? Already dividend has been given. So minority interest has no effect in this dividend. Okay, if pre-dividend is proposed, okay, again I am going to see which profit are they going to use for this proposed. And see, this was paid. So since it is already been paid, minority interest has already got it. I have put it in my P&L as a subsidiary company, dividend paid. It's over. But if that pre-dividend is proposed, that means minority interest also has to now take it. It's just proposed. It's not yet paid. So even for proposed, I will see which profits are they going to use to pay. They will always give you that the dividends will be paid from the profits available, on this date. So you will see that date and accordingly you will understand that, okay, it is a pre or a post. Okay. So if pre-dividend is paid, 80% to the cost of control, minority interest will have no effect. But if the pre-dividend is proposed, then 80% I will take it as for cost of control, and I will also give 20% effect to the minority interest because it is yet to be paid. And if there is a proposed dividend, profits from which dividend, how will I come to know it is post? Profits used to pay the dividend. Okay, if it is a post profit, then I will have no effect in my cost of control. It will directly go in my P&L account, dividend received. Only minority interest will have the effect of 20%. Okay. Clear till here? Any doubt, any question you all have so far? It is the right time. I'm available here. You can ask me. Come on. Or if it is good to go, please hit the like button. Any questions you all have so far? Good to go? Okay. Okay, so now if you have got this understanding of cost of control and minority interest, our sums are going to be very simple. Okay, this you have to remember. This chart is going to solve all your problems. Now there are certain additional information which I want to share with you all. Okay, see, I have mentioned everything. I don't want to keep a room for doubt. To decide whether the dividend is pre-dividend or post-dividend, the profit from which dividend is being declared or dividend is being given is very important. That I will consider. Date of declaration of dividend or the date of payment of dividend has to be ignored. Okay. Say if they have not told me only the date of acquisition of the shares by the holding company in the subsidiary company, then I will assume it to be on the first day of the financial year, which is 1st April of a given year. Okay. All the shareholders items of the subsidiary company, I just told you, showed you all the shareholders items only. Equity share capital, revaluation reserve, preliminary expense, general reserve. All the shareholders items, I will split it in the holding company's share and minority interest share. Everything else, all the other assets, total assets or the other liabilities which are there, everything else I will just add to the holding company's assets and balance sheet and just prepare the balance sheet. Only the shareholders items I will do the treatment. Okay, what are the shareholders items? All the share capital plus reserves and surplus minus your preliminary expense, which is a fictitious asset. It has no value. It is like a burden. It's like an expense which is not written off. That is why we are showing it in the asset side. Okay. So fictitious asset we subtract, we get the shareholders item. So for those who are doing MCQs, okay, for them also this is very important. You should know shareholders items plus all the reserves and surplus, all the pre ones minus the fictitious asset will give you shareholders items. Multiply that by the ratio 80% or 75% and there you get your cost of control. Okay. Then there is something known as concept of mutual owing. Now what does this mean? That holding company is the parent of the subsidiary company. They might be the debtors and creditors of each other, no? It can be, no? See, if the holding company has to receive some amount from subsidiary company or vice versa, holding company has to pay some amount to subsidiary company, the same will be known as a mutual owing and therefore that will be cancelled from the books of both the companies. Why? Because now they have come into a relationship of control. Okay, if there is a mismatch in the mutual owing, then you will cancel it with the least of the amount. It can happen that the holding company's bills receivable from subsidiary company, okay, is showing 4,000 and bills payable, okay, bills payable of holding company, it is showing in the books of subsidiary. This will be showing in the books of holding company, showing as bills receivable from subsidiary and bills payable of holding company is standing at 5,000. I will do the mutual owing with the least of the amount and cancel it, 4,000, and I will cancel it. Okay, only if there is a mismatch. If the holding company holds some debentures of the subsidiary company, again this will be a mutual owing and therefore it has to be cancelled from both the company's books. There can be any profit or loss on cancellation. If there is any profit and loss, then you take that profit or loss in the P&L statement of the holding company. How will you calculate the profit and loss? Cancellation is always done at the face value. You cannot cancel it otherwise. You will cancel it at the face value. So say there were debentures of subsidiary company and they had issued that to the holding company. Face value of those debentures is 70. You will compare the face value with the market price and market value say is 60,000. And now if you are cancelling this debentures, so when the face value is greater than the market value, obviously there is a 10,000 rupees profit due to this cancellation of debentures. It will be credited to P&L account, and if the face value is less than the market value, there will be a loss. It will be debited to the P&L account. Okay. Cancellation of debentures from both the books. Okay, so if the debentures of the subsidiary company were issued to the holding company, means holding company is a debenture holder, is the creditor of the subsidiary company. When I will cancel it in subsidiary company, we are going to now cancel it. We are holding in subsidiary now. So we will compare the face value with the market value. Okay, if the face value is greater than the market value, there will be a 10,000 rupees of profit. Okay, because in the market as it is, the value of the debentures is less. That means now we are saved with that liability by 10,000. Okay, so profit. And if the face value is less than the market value, 10,000 will be your loss, and that will be debited to the profit and loss account. Okay. If they have not given any date of profit and loss reserve, we will assume that profit and loss to be totally. Okay. If the acquisition is on the first day of the year, then opening balance of that P&L account will be pre, and the current year's balance will become post. Okay. Current year's balance will become post. Opening will become pre. Okay, if the acquisition is on the first day of the year, even if it is on any other day of the year, suppose say opening balance is given and acquisition is on the 1st of April and opening balance of P&L is given, this opening balance will be pre, and whatever profits I have made during the year, during that current year, that will become post. Okay, and say if the acquisition is on the last day of the year, 31st of March, then the entire reserve will be pre, full reserve opening plus the current year's profit. That will give you the closing, no? So that entire reserve will become pre. If it is anything, any shareholders item which is pre, we will consider it for cost of control treatment. Okay, clear so far? Any questions to be asked? These are all the important concepts which we need to remember before we start solving a sum on consolidation. So, am I good to go? I hope there is no doubt in this particular question so far. Okay, now we'll begin with the problems, questions. Let us first understand the question. Let us read first and then understand it. Question number 1. Okay. The balance sheet of H Limited and S Limited as on 31st of March 2012 is given below. Okay, so they have given me H and S. There is a share capital, authorized, issued, subscribed and paid up share capital, equity shares of 100 each, fully called up and paid up. Okay, so for H it is 6 lakhs, for S it is 2 lakhs. Reserves and surplus I have profit and loss account 80. Current liabilities of holding is 75 and of the subsidiary is 48,000. We got the total assets. Sorry, total side of the liability. Now the asset side, in non-current assets we have fixed assets 5,55,000 of holding and 2,48,000 of subsidiary. Shares in S Limited at cost. It is shown in the holding company's balance sheet. holding company doing investment in subsidiary company. It will appear on the asset side in the investment side, investment tab, the investments done in the subsidiary company at cost, that is 2 lakhs. Okay, we have to find the cost of control. Okay, let us understand this. Now first, as per this question 1, no, if there is a wholly owned subsidiary company, wholly owned means what? The holding company is holding 100% shares of that subsidiary company. Okay, so how will I find the cost of control then in that case? Then the investment of holding company in the subsidiary company, the cost of investment, is subtracted by the net assets of the subsidiary company in order to get the cost of control. Okay, because there is nothing like ratio 80%, 20%. If you see, this is a totally, completely, wholly owned subsidiary company. There is 2 lakhs standing in the subsidiary company's share capital amount, and they have told us long-term investment shares in S Limited at cost 2 lakhs. Okay, so how will I calculate this? See, as per this given question number 1, subsidiary limited is the wholly owned was 100% held by the holding company. Okay, wholly owned subsidiary, WOS is wholly owned subsidiary. I have done this one sum so that in case they ask you, it is easy to solve. You don't have to do any division of any ratio. Okay, so investments cost is how much? Or investment paid by the holding, cost of investment by holding company is 2 lakhs. We will calculate the net assets of the subsidiary company. Okay, what do you mean by net assets? Total assets minus outside liabilities. Okay, so how much are the total assets of the subsidiary? See here, 2,48,000 are the total assets. There is nothing in investments. So total assets is 2,48,000 minus outside liabilities. Outside liabilities is only 48,000. Okay, so in order to get the net assets, I will say total assets of subsidiary 2,48,000 minus outside liabilities is 48,000. My net assets is 2 lakhs. Investments paid was 2. Net assets value is also 2. So nil, I am getting 0. If there was a difference between this investment cost and net asset, then that amount would have been goodwill or capital reserve accordingly. Here the cost of control is nil. Nothing. Because I got 0 as amount. Nil. If it would have been a positive amount, okay, investments cost is less than the net assets as I had told you, then yes, it would have been treated as capital reserve, or if it would have been treated as goodwill. Okay, this was one sum which was for wholly owned subsidiary. I thought it is better I explain you this also. Rest all the concepts I have given you all the notes. This one thing we will be able to solve it if in case they ask you. Okay, come on, I'm going to question number 2 now. Easy question, simple one I have taken. See, following are the balance sheet of S and S Limited on 31st of March 2007. Okay, so liabilities in that they have given rupees, shares of rupees 100 each. So this is share capital, 5 lakhs and 2 lakhs of subsidiary. General reserve opening balance. See, 31st March is the balance sheet date. General reserve is the opening balance. 1 lakh for holding, 60,000 for subsidiary. Profit and loss account is 1,40,000 and 90. Bills payable is there in subsidiary as 40,000. Creditors 80 and 50. Okay, total. In assets, we have goodwill of holding company, goodwill of subsidiary, In other fixed assets, 3,60,000, 2,20,000. 1,500 shares in subsidiary company, it is given to me. How many shares I have it in subsidiary? 1,500. The cost of my investment is 2,40,000. Stock, debtors, cash at bank. Profit and loss of S Limited showed a balance of rupees 50,000 on 1st of April 2006. Find the cost of control and minority interest. Clear? Question understood? They have given me. Okay, now let us solve this step by step. First, I have written date of acquisition not given. Okay. Date of acquisition is not given. So I will assume it to be on the first day of the year, 1st of April 2006. Now to find the number of shares, they have given me 1,500 shares. How many shares the subsidiary company has? Their capital is rupees 2 lakhs. Here. 2 lakhs capital. Shares value, each value is 100. So that means 2,000 shares subsidiary company has. From that, holding company is holding 1,500 shares. So what will be the ratio? 75% and 25% will be minority interest. I will take all the shareholders items and start dividing. Easy. This I got it. Now the first shareholder item is equity share capital of the subsidiary company, which is 2 lakhs. It is always pre divided between the holding and minority interest, 75. So 2 lakhs into 75%, that will give you 1,50,000. Balance will be minority interest. General reserve, in the question only they have told me it is the opening balance. That means it is pre. We are assuming the date also to be the first day of the year, 1st of April 2006, and they have given me date also. So general reserve 60,000, it is pre. I will divide that by 75 and 25. Holding company 45,000 and minority interest will be 15,000. Coming to the profit and loss account. Now pay attention. Okay. Profit and loss account, opening balance is given to me here in the notes of the balance sheet. See, P&L Limited showed a balance of 50,000 of S Limited, showed a balance of 50,000 on 1st of April 2006. This means this is the opening balance. And in the balance sheet, if you will see, no, profit and loss of S is 90. Closing balance 90,000. Okay, so how will I calculate this? How will I work this out? First, P&L of subsidiary company, opening balance given. Okay, this is given. On 1st of April is standing at 50,000 and closing balance as on 31st March 2007 is 90,000. These things are given. So I make a timeline from 1st of April 2006 till 31st of March. Okay, timeline. I am writing this 50,000 here. I told you anything that is pre, just divided between holding and minority interest, 75% and 25%. So pre will be considered for the cost of control. Anything that is post, it will go to the P&L of the holding company directly. Now, how much will be the post? Since the closing is 90 and I opened with 50, my current year's profit, which is the post profit, will be 40,000. 90 minus 50. 50,000 was opening. In the year I earned 40. Therefore, in the closing I could stand at 90,000. So 40,000 is the post profit. This will have no effect in cost of control. It will go in the P&L account, credit side. Minority interest share will go in the minority interest account. Okay, we will add everything of minority interest. Okay, this will go in the minority interest account, credit side. Everything related to the cost of control, we put it in the investment account of H limited, and then try to find out the cost of control. You can do it directly also without making the ledger. Okay, now see this. Cost of control, they have told me to find the cost of control. So investments cost paid or investment amount paid minus shares in the net assets or share in the shareholders items. Okay, so cost of control is nothing but the investment cost minus the share in the shareholders item. Investment cost, from where I will get it? From the balance sheet. See this, they have given me the cost 2,40,000. Rest everything I found out: share in equity share capital, share in general reserve, share in profit and loss. When I will subtract all, I'm getting a positive 7,500. That means investments is more than the net assets or the shareholders items. I have paid more. So it is a goodwill. Cost of control is goodwill of 7,500. See, I have marked all this cost of control. Equity share capital 1,50,000. This will go as a cost of control. General reserves 75%, that 45,000 will go as a cost of control. And in case of P&L, 37,500 will go as a cost of control. All these shareholders items I have taken it. There is nothing else in the balance sheet. See, is there anything? Is there any fictitious asset or something? No. Okay, there is nothing. So, and minority interest, you will add all the 25% of equity share capital, then general reserve, then profit and loss pre, and profit and loss post. Okay, see, minority interest for pre it was 12,500 and post is 10,000 we could find. But for minority interest you will add, no? For them pre and post, what their total amount. There is nothing pre and post for minority interest. It will be 12,500 plus this 10,000 total of P&L. So I added them. I got 87,500 as the amount for minority interest. Clear, everyone? Understood? This is what they are going to ask in the exams. You are supposed to solve it with the proper working notes and give the answer. Okay, if in case they are asked you to solve and give a balance sheet also, which they generally do not, they don't ask that much because it is for 10 marks maximum, so they don't ask a balance sheet. But you want to revise this same sum with the help of the balance sheet. It is there in my dream batch, the same question. It is given with the balance sheet and the ledgers. You can just go ahead and do those sums also. Okay, clear, everybody? Next question, you all will be able to solve it by yourself. Let's see, let us read it and then I'll give you some time to solve. Balance sheet of X Limited as on 31st of March 2005. Authorized and issued 12,000 shares of 10 each, general reserve, P&L, trade creditors. And on the asset side, I have freehold premises, plant, shares in the subsidiary company at cost, 2,000 shares at rupees 10 each, 25,000. Stock, debtors, bank balance. Balance sheet of Y Limited, authorized and issued capital is 3,000 shares of 10 each. General reserve on 1st of April 2004, correct the date. P&L, trade creditors, leasehold property, plant, stock, debtors and bank balance. At the date of the acquisition of X Limited, that means X Limited is the holding company, no? Y Limited is the subsidiary company. X Limited, at the date of acquisition of X Limited of its holding of 2,000 shares in Y Limited, the latter company had a credit balance of rupees 6,000 in P&L account. Okay, now what is the date of acquisition? Have they given? They have not given. So I am going to assume it. It is going to be on the first day of the year. We have to find the cost of control and minority interest. Same like the first question. Okay, so I am giving you all the notes, the starting notes. Date of acquisition I have assumed as 1st of April 2004 because nothing is given. Holding company is holding 2000 shares out of the 3000 shares of subsidiary company. Okay, which is the holding company X Limited and subsidiary company is Y Limited. So what will be the share 2/3 and 1/3? Okay. Instead of doing 66.67%, I have done 2/3 and 1/3. It becomes easy for solving. If you get this point in percentage point, no. Rather, I have taken 2/3 and 1/3. Cool. So all the shareholders items, I can take it and then just divide by 2/3, 1/3 and solve it. So which are the shareholders items of the subsidiary company? I will see the balance sheet of subsidiary now. Okay. Shareholder item will be equity share capital. It will be general reserve and it will be P&L. But for P&L, I have to be careful. Opening balance was 6,000. And closing is 9,000. So same like the previous sum. So come on now, solve it. Give me the answer for minority, for the cost of control. Come on. I am not giving you all these answers. I am keeping the balance sheet open over here. You all have to answer. Give me the amount of cost of control. Okay, 1 minute. I'm giving you all to solve. This is the balance sheet kept over here. How will you find the cost of control? The amount of cost in the investments done by the holding minus these shareholders items. Which are those shareholder items? Only 3. Equity share capital, general reserve and P&L. Come on, let me see who is solving it fast. And the first. How much did you all get cost of control? Who has finished solving? I'm keeping the solution now here. See. Nobody has solved it yet? Come on, someone to give me the answer. 28,000 is the cost of control. Okay. Let us see whether it is right or wrong. Oh my god, I have got cost of control as 3,000. That also in form of capital reserve. Chalo, let us see. Let us solve and see. Equity share capital of Y Limited is 30,000. So equity share capital is always free. Divide by holding shares and minority interest share 2/3 and 1/3. So 20,000 and 10,000. This I will take it for cost of control. Clear na? Equity share capital done. Then general reserve. General reserve also they have given me the date 1st of April 2004. So it is free. 2/3 and 1/3 cost of control will be 4,000 for holding. And in case of minority interest we will take 2,000. P&L of Y Limited. Closing is given to me. in the balance sheet, and opening they have given me in the notes. 1st of April opening was 6,000. Opening will be always pre. That pre amount I will take into consideration for cost of control. Okay, 2/3 will be 4,000, 1/3 for minority interest. And for the post, how will I get the post one? I will have to find the current year's profit. I made a timeline. 1st of April 6,000. Closing was 9,000. That means in the current year I made a profit of 3,000. That will become my post profit. Post profit also I will divide 2/3 for holding and 1/3 for minority interest. That 2/3 of holding, since it is a post profit, we will not consider it for the cost of control. This will go in the P&L account directly of the holding company on the credit side, like a normal profit. Yes, and minority interest 1,000 and 2,000 over here. So total minority interest for P&L is 3,000. And for cost of control for holding shares it is 4,000. Now all these items I know it. I will minus it from the investments cost. Now how much is the cost of investment? See, it is given over here. Shares in subsidiary company at cost 25,000. This is my cost of investment. That I will subtract it from shares, shareholder items minus net assets or shareholder items, which is equity share capital, general reserve and P&L. I am getting 3,000. That means this is more. 20 plus 4 plus 4, 28,000 is more than 25,000 now. So my cost is less than my net assets. Therefore, I am going to get it as a capital reserve. And minority interest, all the shares I will add it. Equity share capital. Okay, general reserve, P&L, P&L, P&L pre, P&L of the post. Total will be 15,000. Clear everybody? Now, easy. Only one person has answered. 28,000 was the total. Okay. So, very good. At least took the attempt. Others are not solving, I think so. Next one. Same thing again. Find the amount of cost of control and minority interest. Equity shares 10 each fully paid up. Of Vipul Limited is 10 lakhs. Vedika is 2 lakhs. General reserve, P&L, creditors and then the total. In assets we have fixed assets. 70% of shares in Vedika. That means Vipul is the holding. Vedika is the subsidiary company. So investment cost is given 1,42,000. Current assets, discount on issue of shares, fictitious asset. It is a shareholders item 5,000. Okay. On 31st of December 2011, Vipul Limited acquired shares in Vedika Limited. Okay, so now they have given me the date of acquisition. On 1st of April 2011, Vedika Limited's profit and loss showed a debit balance of rupees 8,000. On 31st March 2012, Vedika Limited decided to reevaluate its fixed assets at rupees 2 lakhs. Find the amount of cost of control and minority interest. Okay, so now pay attention. Okay. Date of acquisition, question number 4, it is given 31st of March 2011. Cool. Holding company share is also given 70%, which is Vipul. So minority interest is going to be 30%. Okay, I will start taking the shareholder items of the subsidiary company. Now, which are those? Shareholders items. First is equity share capital. Then general reserve is not there. I will take P&L. Okay, and then I will also take this fictitious asset 5,000. I will start dividing these shareholder items. So come on. Equity share capital is 2 lakhs, 70%, 30% holding and minority. So this 1,40,000 I will take it for cost of control. Okay. Second one, there is no general reserve, but there is revaluation reserve. Now, how did I come to know that? See, they have given that on 1st of April, no, on 31st of March 2012, on the last date, okay, they decided to revalue the fixed assets at rupees 2 lakhs. Now, if you will see the fixed assets of Vedika is standing at 1,80,000. They did a revaluation and now they are saying that it should stand at 2 lakhs rupees at the end of the year. Okay. 31st December is the date of acquisition. Revaluation has taken place at the end of the year. So you will say, ma'am, now how will we divide the profits? Nothing doing. Revaluation reserve is always pre. I have got a reserve over here. Always pre. Revaluation reserve. How much will be my revaluation reserve? 20,000 na? 1,80,000 it is in the balance sheet, but now I am going to show it at 2 lakhs rupees. Though there is no actual cash of profit, but 20,000 is my reserve of that subsidiary company of Vedika. That is always pre because it is of those assets which were always there before the holding company has come in. Okay, so revaluation reserve which is pre 22 lakhs minus 1,80,000, 20,000 is the reserve. Holding companies share 70 and minority interest 30. So 14,000 will go in cost of control. Then general reserve, as I told you, is not a P&L. We will do always last. Okay, rest everything we will first finish it off. Discount on shares, fictitious asset. Okay, fictitious asset. 5,000 is given. It is always pre. Divide that by holding and minority interest. Cost of control 3,500 debit. For minority interest also it will be debit. It is like a loss. Okay. And then the last one, profit and loss account. Now pay attention. Profit and loss of the subsidiary company, they are saying that on 1st of April it was a debit balance. Debit balance on 1st of April 2011. 8,000 rupees was a debit balance. I made a timeline and I said 31st of March 2012. In closing, how much it is the P&L? If you see the closing P&L is 40,000. 40,000 is the closing P&L. So, I have written my closing P&L 40,000. Opening P&L is 8,000. That means during the current year, how much profit I made? I started with a loss and I closed at positive 40,000. That means I made 48,000 in the current year. Only then this loss can be written off and I will stand at 40,000. Right? How I get my current year's profit? Closing minus opening. Closing is 40,000. Minus opening is minus 8,000. Minus and minus plus. I am teaching you maths. Okay, which we did in childhood. So minus and minus plus 48,000. Clear na? Okay, but I have come on 31st of December. So there is a pre 9 months and post is of 3 months as per the timeline. Okay. Pre and post as per the timeline of my date of acquisition is 9 and 3. So this 48,000 of current year's profit will be divided as pre and post again. If it would have been date of acquisition like other sums we did, 1st of April, date of starting date of the year, then the current year profit totally becomes a post profit. But since I have come in the middle of the year, somewhere on 31st of December, so here the current year's profit also I will have to divide in pre and post. Okay, so 48,000 pre and post in the ratio 9:3. So 36,000 will be pre and 12,000 will be post. Now pre, 8,000 is pre, debit 8,000 is pre, and plus 36,000 is post. So actual pre is 28,000. Opening balance, which is debit, I will remove it from pre and pre. No, if it would have been positive, I would have added. Total will be this pre opening plus the current year's pre. So when I'm adding it, obviously I'll get 28,000 because this 8,000 is a negative, it's a loss. So now this 28,000 I will divide between holding and minority to get my cost of control amount. And this post 12,000 holding company minority interest I will divide, but the post amount will go in P&L credit side. Only the minority interest you will add it, 3,600 plus 4,800 here, 8,400. This two we will add it for minority interest. Okay. Understood? Okay, since the acquisition has come up between the year 31st of December, my current year is also divided in the pre and post ratio timeline, 9:3. So current year's profit, which is 48,000, I have divided as pre and post. Now pre, I have to take the total opening plus this pre which I calculated. Now since in the opening it was negative 8,000, my pre-profit is going to reduce and come up to 28,000. That I will divide between holding and minority and get the cost of control amount. And the remaining post 12,000, holding subsidiary I will divide holding and minority interest, but holding share will go directly in the P&L. It has nothing to do with the cost of control. Minority interest share we will add the total. Okay. So how will I get my cost of control amount? It will be the cost of investment. How much is the cost of investment? 1,42,000. From there I will subtract the net worth or net assets or shareholders items. Okay, so net investments paid cost 1,42,000. Share in equity share capital we did, it came to 1,40,000. P&L we just did. Okay, the share of holding company in P&L is 19,600. Revaluation reserve is always pre. See, all the cost of control I have put it in this square. So 14,000 of revaluation reserve. Equity share capital 1,40,000. Okay, discount on shares is 3,500, but that is debit amount, na? So I will minus P&L minus revaluation reserve and I will add discount on issue of shares. It's like a loss. Okay, so my cost of control is coming as a positive. It is a capital reserve. Okay, I have paid less than the worth. How I came to know? Calculate this total worth. Total worth is 1,40,000 plus 19,600 plus 14,000. From that minus 3,500. Okay, it is coming as total worth is 1,70,100. From that we will subtract 1,42,000. So I am getting a capital reserve as my cost of control. And for minority interest we will add all the items. Equity share capital. Then this 6,000 is, I think so, of revaluation reserve. No. Yes, 6,000 is of revaluation reserve. Minus 1,500 I will do of the fictitious asset, discount on shares. 8,400 P&L pre and 3,600 was P&L post. Clear everybody? Any doubt so far? Any question you all have any to ask? You all can take a screenshot of this P&L working. Take a screenshot. There will be 2 questions of consolidation if they are asking you about cost of control and minority interest. Definitely. For the new syllabus. Okay. You all can take this also as a screenshot, the working of cost of control and minority interest. Okay, clear? I'll move to the next one. Any question so far? Good to go? I'm doing a few past exam questions. Okay, sure. So all the other concepts also will become little clear. Holding Limited, H Limited is the holding company of S Limited. During the year 2018-19, bills receivable amounted to rupees 4 lakhs out of the total bills receivable of 5 lakhs received from S Limited were discounted by H Limited. And S Limited had endorsed to its creditors all the bills received from H Limited amounting to rupees 3 lakhs. At the end of the year, the amount of mutual debtors will be how much? Now there is H Limited and there is S Limited. Okay, listen to me carefully. Total bills receivable, okay, of H Limited is 5 lakhs. Okay, total bills receivable is 5 lakhs. Bills receivable amounted to 4 lakhs out of total bills of 5 lakhs which are to be received from S Limited. That means to be received from S Limited it is 4 lakhs mutual owing. Okay, and in debtors we are doing both. Okay, in trade debtors we do bills receivable plus debtors both. Okay, so and S Limited had endorsed to its creditors all the bills received from H Limited amounting to rupees 3 lakhs. So S Limited also had some bills receivable and they had discounted them to the creditors totally. Okay, here the mutual owing is only 4 lakhs. So basically the amount left as the mutual debtors, it will be how much? Rupees 1 lakh. Okay, the one which was discounted, sorry, the amount discounted is 4 lakhs. So the mutual owing is basically only of 1 lakh. Okay, H Limited, I'll again repeat the question and explain you. See, H Limited is a holding company of S Limited. I have written H and S. In the year 18-19, bills receivable amounted to rupees 4 lakhs out of the total bills receivable of 5 lakhs received from S Limited. They were discounted by H Limited. Okay, so total bills receivable of H is 5 lakhs. From that they discounted 4 lakhs. Okay, that was which was they were to be received from S. They have totally now discounted 4 lakhs. and S Limited endorsed to its creditors, gave those bills receivable to its creditors, all the bills that were received from H Limited amounting to rupees 3 lakhs. So S Limited also had total bills receivable 3 lakhs and they also discounted 3 lakhs. So here it is nil, 0. So mutual owing will be only of 1 lakh rupees, because from the total bills receivable, H Limited has already discounted 4 lakhs. Okay. So mutual owing is of 1 lakh here. At the end of the year, this will be the mutual debtors between H Limited and S Limited. Okay. Next question. Okay. On 1st of April 2019, H Limited has purchased 16 lakh equity shares of 20 lakh equity shares of S Limited. The following information is provided as on 31st of March by S Limited. Okay, now this, if you think that it is an MCQ format, it is not applicable for new syllabus, you can go and see the December 2023 paper. They have asked you the same question, similar, 5 marks. Just that you have to solve and show. Okay, since I have just given the options of the answers so that it can be used for the old syllabus also. But they have asked you a similar question changing the numbers for 5 marks. Okay, so equity share capital over here 20, they have given me the information of subsidiary company. No, S Limited is subsidiary company. Okay, so it is 200 lakhs, 45 lakhs and statement of P&L is 32 lakhs. On 1st of April 2019, a machine of S Limited was revalued by H Limited and 25% above its book value of 12,50,000. The amount of minority interest will be, okay. So first I will start taking all the shareholders items. Equity share capital, it is 200 lakhs. I will divide that between the holding company and minority interest. How will I get the holding company and minority interest ratio? 16 divided by 20, the ratio. 80%. Okay, so 80% is the ratio. Holding companies 200 lakhs into 80%, 160 lakhs. Balance, it will be 40 lakhs of minority interest. I am telling you, do both minority interest and also do this holding company share. We do not have the cost of investment, but it is okay. I am solving both. Then after equity share capital, it is general reserve 45 lakhs. Divide that between the holding company and minority interest. 45 into 80%. 36 and 9 lakhs. Then they have P&L. How much is the P&L statement? 32 lakhs. There is no opening, closing and all that over here. Okay. So 32 lakhs holding and minority interest. 32 lakhs into 80%, 25.6. So this will be 6.4 lakhs minority interest. Only in this they have given you that there was a machine of S Limited. H Limited has revalued it 25% above its book value. That means that 25% will be the profit na. So 12,50,000 into 25%. 25% above its book value. So in book it was standing at 12,50,000. Book value is 12,50,000. Now I am going to show it at 25% above. Okay, so this 25% is now going to be 3,12,500. So now in the balance sheet, basically it will go as 15,62,500. This the amount will go in balance sheet of that asset. But what is the revaluation reserve? devaluation reserve is 3,12,500. 3,12,500. So holding company and minority interest. How much it is? 80% and so 80% is 2,50,000. This is 62,500 minority interest. Okay, I have to find the total of minority interest. Simple. Just do the total. 40 lakhs plus 9 lakhs plus 6.4 lakhs and 62,500. Add them all. You will get 56.025 lakhs. Okay, 140 plus 9 plus 6.4 plus 3.1. 158. Okay, sorry, 56 lakhs, 56,025 lakh will be the amount of minority interest. Okay. Clear? Chalo, now the next one. Next question. Okay. Holding of H Limited is 75% of S Limited. Other information obtained from the books of S Limited is as follows. Share capital, general reserve, surplus of P&L and capital reserve. If the cost of investment of the shares in S Limited for the H limit is 162 lakhs, amount of cost of control will be how much? Now here you can directly do a, in case of for net assets, you can add all 150 for net assets. Okay. Or you can say shareholders items. Total. So total will be 150 plus 25 plus 35 plus 10. That is equal to 220 lakhs. Take 75% of that. 165 lakhs. Okay, they have told me the cost of investment for H Limited is 162 lakhs. Okay, investment cost is 162. Therefore, cost of control is how much? 3 lakhs. And that will be in form of capital reserve. Okay. Next question. On 30th of June 2018, 2/3 of the shares of S Limited with total capital of 48 lakhs rupees was acquired by H Limited. Okay, so H has 2/3. So minority interest will be 1/3. The balance sheet of S Limited showed a debit balance of rupees 24 lakhs on 1st January 2018 and credit balance of rupees 14,40,000 on 31st of December 2018. The investments by H Limited in the shares of S Limited is rupees 36 lakhs. Calculate the cost of control in this acquisition. Okay, now they are having the opening and closing as 1st of Jan, the year, and this is 31st of December. Okay, I am just making the timeline. And the date of acquisition is in 30th of June 2018 year. on 30th of June 2018. Okay, so 6 months will be pre, 6 months will be post. I have to find the cost of control. I have the equity share capital, but I need to know the amount of P&L also. Okay, so now on 1st of January there was a debit balance of 24 lakhs. It was a loss. And then on 31st of December I am standing at a positive balance of 14,40,000. That means in the current year I made a profit of 14,40,000 plus 24 lakhs. 38,40,000 will be my current year's profit. From negative to stand at positive, okay, it will be closing minus opening. You will get 38,40,000. Minus and minus is plus. So now this current year I will divide it as pre and post. Okay, 1:1. Okay, the ratio is 1:1. So 19,20,000 and here also 19,20,000. Okay. For this 19,20,000, I will take it for holding company and minority interest. 2/3 and 1/3. Right? 2/3 and 1/3 they have told me. 19,20,000 divided by 3. So this is going to be 12,80,000. Okay. 12,80,000. This is going to be 6,40,000 minority interest. Now total of pre 24 lakhs negative and positive 12,80,000. Okay. Okay, so this is going to be total of pre. Now pre, this 24 lakhs also, since it is pre, I will take it with holding company and minority interest. 2/3 and 1/3. So this is going to be 16 lakhs. Okay. And the balance, it is going to be 8 lakhs of minority interest. Okay, so now this 16 lakhs negative and this 12,80,000 is going to be my positive. Okay, so how much will this totally become? 12,80,000 minus 16 lakh. Okay. This is 12,80,000 of pre and post, and 24 lakhs is pre. From that I take the 16 lakhs also. Okay, negative. So negative 16 lakhs minus 12,80,000. I'll get negative 3,20,000. Okay. Now I have to find the cost of control. So for cost of control, I am taking all the pre items. So I got 16 lakhs negative as pre item. I am taking it like this. Okay, then I got a positive pre item in the profit 12,80,000. Okay, it is plus. Then we have equity share capital. equity share capital is going to be total capital of 48 lakhs. So 48 lakhs into 2 divided by 3, 32 lakhs equity share capital. Correct? So total will come as 32 lakhs plus 12 lakh 80,000 minus 16 lakhs. Okay, 28 lakh 80,000. Okay, now 28 lakh 80,000 minus the cost of investment. Cost of investment they have told me is 36 lakhs. So minus 36 lakhs. Okay, so I am getting a negative 7 lakh 20,000. So that will become my goodwill. Okay, that will become my goodwill. 7 lakh 20,000. Clear? I am explaining you all once again because of this profit and loss amount. Okay, profit and loss amount, the pre one is always divided between holding and minority interest. Current year is also divided between holding and minority interest. Okay, but if the date of acquisition was the first day of the year, then the pre would become, the opening would become pre and the current year total would become post. There was no problem in that. But if the acquisition is in the middle of the year, then the current year's profit also becomes pre and post. So how do I divide that? How do I calculate that? Okay, since they have given me that 1st of January it was 24 lakhs negative, and then when they closed the balance sheet on 31st December, they closed it on positive 14 lakh 40,000. That means my current year's profit is 38 lakh 40,000. So this current year I cannot treat it as post. Why? Because I have come in the middle of the year. So I will have to divide it as per the time ratio, which is 1:1. 6 months, 6 months, 1:1. So 19 lakh 20,000 is pre and 19 lakh 20,000 is post. Okay, I also had one opening balance which I always told you that it has to be divided between holding and minority interest for holding company, and for minority interest share is there. Okay, so this will be divided as 16 lakhs and 8 lakhs. So for total pre for holding company's cost of capital calculation, it will now be 12 lakh 80,000 and that 16 lakhs. From 9 lakh 20,000, holding company share is 12 lakh 80,000, and from 24 lakhs, holding company shares is 16 lakhs negative. Okay, so basically there is a negative 3 lakh 20,000 effect. Okay, negative 3 lakh 20,000. So that I could have done it with the help of this 32 lakhs. Okay, minus 3 lakh 20,000. I would have got the same answer. Okay, so this is what I have done. But in the cost of control statement, I am showing you everything. This is the opening pre of the holding company. Then this is the current year's pre of the holding company, and this is the equity share capital. So I get 28 lakh 80,000. Cost of investment is already given to me. So my cost of investment is higher than my shareholders items. Therefore 7 lakh 20,000 will be the goodwill amount. Clear? Okay, any question you all have want to ask, any doubt you all have over here, you all can ask me. Okay, I'll move to the next question. Chalo. A total capital of the subsidiary company is rupees 3 lakhs, and out of this 2 lakh 40,000 is owned by the holding company. What is the amount of minority interest if percentage of outside shareholder is 80%? Percentage of outside shareholder is 20%, means holding company and minority interest. Outside shareholders means minority interest is 20%. Okay. So the total capital is 3, out of which 2,40,000 is of the holding company. So equity share capital of the subsidiary company is 3 lakhs. Okay. Holding company and minority interest. Minority interest is outside shareholders. So this is 20%. So 3 lakhs into 20%, this will be 60,000, because 2,40,000 obviously is of the holding company, which is at the rate of 80%. Answer is 60,000. Okay. Next. Oh, this is something new. What is the amount of unrealized profits to be eliminated if the parent year end inventory includes at rupees 5,40,000, which is goods invoiced to its subsidiary, to it by its 60% owned subsidiary at cost plus 25%. Now I'll explain you what is this. What happens is that your subsidiary company is selling goods to the holding company. Okay. So holding company is the buyer, subsidiary company is the seller. Now when the subsidiary company is raising the invoice to the holding company, it is charging as cost plus profit is equal to selling price. Okay, they are saying that they are taking 25% of profit. Okay, whenever they say cost plus profit, I will always assume cost to be 100. Okay, if cost is 100, profit is 125, so 125 will be the selling price. Okay, now what happens is when you become holding and subsidiary, whatever goods which are lying with me, which I'm supposed to sell it to my holding company, I'm not going to make the profit now on it. It will remain unrealized profit on that stock. Okay, so my stock is 5,40,000 rupees, 5,40,000 goods invoiced to it by its 60% owned subsidiary. Okay, so in the holding company's inventory, they are having 5,40,000 rupees stock remaining. From whom they have purchased this? They have purchased it from subsidiary company. Okay, understand the question. They have purchased this from the subsidiary company. So the cost to the holding company is the selling price of the subsidiary company. So how much will be the unrealized percentage of profit? 5,40,000 into 25 divided by 125. 1,08,000. This unrealized profit, I will remove it from the P&L also, and I will remove it from my stock amount also. Understanding? What is the scenario over here? You will find this question being asked. Okay. Subsidiary company is basically selling goods to the holding company, and whenever they are selling the goods, 100 rupees is the goods, they are putting 25 rupees profit and selling that goods at 125. So the selling price of subsidiary company is becoming the cost price of the holding company, or vice versa. Cost price of holding company is given 5,40,000. The goods is standing in the inventory. Inventory is always valued at cost. Unless it is sold, then it will be sold at the selling price. Barabar? So holding company inventory is having this stock valued at rupees 5,40,000, which they have taken from the subsidiary company. Now even if they are going to sell it, there is going to be an unrealized profit for the subsidiary company. They are not going to get this profit. Subsidiary holding has become 1. So what is that amount of unrealized profit? 5,40,000 is the selling price for the subsidiary. So what will be the profit for the subsidiary? 1,08,000. This I will remove it from the stock price of this 5,40,000 for the net effect in the balance sheet. In the balance sheet, I will give stock as 5,40,000 minus 1,08,000. And the second effect of this unrealized profit is I will debit my P&L account, profit and loss account, by 1,08,000. Clear? Unrealized profit. Okay. Unrealized profit also generally you divided holding and minority interest and accordingly debit that much of ratio of holding and balance you take it to minority interest. Okay, so if in case you have subscribed to my dream batch, go ahead and watch all the detailed questions and problems I have solved on all this type of situations which they have given. Clear? Okay, chalo next question. A Limited paid rupees 9 lakhs for 70% of equity in B Limited on 1st of April 2019. On this date, B Limited share capital was 10 lakhs rupees, retained earning is 5 lakh rupees. All of the assets and liabilities of B Limited were recorded at the fair value. A Limited interest in B Limited will be of how much? They are asking holding company's interest in B Limited will be how much? See, cost of investment I know is how much? Rupees 9 lakhs. Okay. Now interest of A Limited in B Limited. How will I calculate? It is 70%. So 70% of equity share capital plus what do they have? Any pre-acquisition reserves, which is retained earnings they have. So 70% of equity share capital is 10 lakhs plus 5 lakhs. So 70% of 15 lakhs, which is 10,50,000. They are asking me A Limited interest in B Limited. Okay. They are not asking me the cost of control. They are asking me the amount of interest in the shareholders items. It will be 70% of those shareholder items. Correct? So it will come as 10,50,000. Okay, students. So I have solved these past exam questions with a view that you will get understanding of holding, minority interest, cost of control, goodwill, capital reserve, because this is all what they are going to ask you in your exams. Okay, and for more detailed practice of balance sheet and making a ledger and all, which is very less likely to be asked in your exams, they may not ask that detail of making a balance sheet and all. Okay, considering your new syllabus, because it is corporate account 60 and financial management also is there of 40 marks. So for 2 questions of consolidation, say 5 marks also, they are going to focus on cost of control and minority interest values. I have given you all enough practice and understanding in this marathon. For additional practice, you can definitely go ahead and watch my detailed lectures. Okay, so far I have completed consolidation of accounts. You all have any questions to ask? You all can please go ahead and put it in the chat box. Any problem you all have not understood, you all want me to repeat it again, I will be ready to do that. Okay, I'm more than happy to solve it. Okay, if everything is okay, you can just give me a thumbs up or put a like or share, hit the like button, and then I will resume back for underwriting of shares and debentures. We have time, we can do that also. The concepts and how to find the underwriter's liability, I will be showing you that. Okay, students, so I see you back again after the lunch break. I will not going to take much time for your of yours, in underwriting. It is a very, very easy topic. Just a basic calculation of how to calculate the underwriter's liability we are going to see in the next class. Okay. So go ahead, take a break and then come back at 1:30. Hi everyone, you all are back. Okay. As I told you that we will be doing the small part of issue of shares, the underwriting of shares, which is a part again of your share capital related only chapter. And it is very, very easy. It is very simple also. So I will just give you an understanding of underwriting of shares and how to find the liability of the underwriters. Okay. Now, before I begin, there is a question which is asked to me regarding consolidation of shares, which we finished just before this, telling me that for the calculation of the pre-profits, I have done two different methods in two different sum. I have not done anything very different. What you can do is the pre, which is the opening profit, okay, and the current year's pre, you can add that together and then divide between holding and minority interest. Or else the pre of opening you can do holding minority, current year's pre holding minority, and then add up for the holding company. Anything you do, you will get that same answer which I had got. Okay, so I have shown you two different ways. Whichever you feel the best, it is going, you can use that and you will get the same answer. You add two total amounts and then divide by two, holding and minority interest is also the same thing. You keep two different pre's and then divide separately and then add up also, it is going to give you the same answer. It is not different. Okay. So now beginning with underwriting of shares. Now let me ask you all, what do you all know this term underwriters, or do you all know what is the meaning of underwriting of shares? Can anybody give me why do we need underwriting of shares or underwriters? You all can hear me and you all can see the screen, right? All of you all. Please, if you can put it in the chat box whether I am audible and you can see the screen. And the question which I have asked for, please kindly answer. Tell me in simple words, what do you understand by underwriters? And when do we need underwriting of shares or debentures in that matter? Okay. Come on, give me the answer to the question. If you all have done this before or you all have done this in company law, Companies Act, underwriting, underwriters. Fantastic. Somebody has replied that if the shares are undersubscribed, we have to take the help of the underwriters. Okay, so in a very, very, yeah, if there is a shortfall in the minimum subscription, correct, absolutely. How much is the minimum subscription? What is the percentage of minimum subscription? Come on, wake up. What is the minimum subscription percentage? It is 90%, na? 90% is the minimum subscription. So if a company is coming up with 100 shares to subscribe to public, at least 90% have to apply, means at least they should get the application subscription of 90 shares. Right. Now what happens if this minimum subscription is not received? We have to refund all the money which we got on application. Okay, so for under subscription, whenever the shares are undersubscribed, there is a situation where the entire issue will fail. So in order to prevent this failure of the issue of shares, or in that matter debentures, the companies appoint underwriters. Okay, they appoint the underwriters so that they take up the liability for these unsubscribed shares and prevent the issue to fail. So to get into an agreement with the underwriters, wherein the companies pay these underwriters commission for the shares, for the liability which they take up. Okay, and underwriters are also there stating that okay, don't worry, if whatever shares are not taken up by the public, we will take it up. So it is their business. Okay, this is their business of taking up the shares, and then later on they will sell that in the secondary market. But underwriters have also got a a responsibility, and their work is also to gauge the market interest. They also assess the company in understanding how much is your companies in, how many people are interested in buying your shares. Okay, how much are they ready to pay for the shares you offer. You will keep the price of 100 rupees, but company is not even ready to pay 50 rupees for your share. So they help you assess the price also of the share. They assess the risk which is involved of this under subscription, or there can be over subscription, and they ensure full subscription of shares if that there is some portion which is not taken up by the public. Okay, so underwriters play a very important role when the companies come to the public to issue the shares. Okay, every company does appoint the underwriter before they come to the issue. So the underwriters then play a very vital and important role in order to assess the company for this entire process of the issue. Clear? So taking all to the basic theory of underwriting, they may or they may not ask the theory so much in detail, but if being asked, I will take you all through it quickly. As I have introduced, okay, underwriting, it is a process. Even you all just told me, it refers to an assurance by the underwriters to take up the fixed number of shares or debentures of a company, irrespective if they are subscribed for by the public. Okay, so underwriters and brokers are different. Brokers merely promise to attempt to secure subscription of shares or debentures issued. Brokers generally play a major role in the secondary market. Underwriters have an important role to assess the companies coming to the public in the primary market. Okay, they underwrite. Okay, they are the institutions, they can be individuals who provide this services of underwriting a public issue of shares or debentures. Now there are two types of underwritings. Okay, quickly I will tell you that, because this is what is important. One is complete and other is partial. Complete means what? I give you an example. Say company A Limited has come up with a public issue of 1000 shares. The full issue is underwritten. They are saying it is completely underwritten. Completely underwritten means what? Whatever will be left out, okay, whatever will be the unsubscribed shares number, entirely it will be taken up by the underwriter. Entirely. Okay. Whatever is remaining in the unsubscribed portion. So say we got only 800 shares as subscribed. Completely 200 shares the underwriter will take it up as his liability. It is different when I say partial underwritten. Partial underwriting means what? Say same example, 1000 shares and it was underwritten by Mr. W to 80% extent. 80% extent means what? Only till the 800. Okay. So the gross liability out of 1000, we will do calculation first on 800. His gross liability will be 800 shares, not more than that. So whatever is remaining, 200, which will be remaining, it will be basically the company themselves are the underwriters for that balance 200 shares. Okay. So if it is partially underwritten, then to the extent of the percentage it is underwritten, it will be taken up by the underwriter's liability. Okay. And the balance will be treated as the company itself is underwriting its own issue. Okay. So here in second case, the underwriter will not take up even one share beyond 800 if he has to take up. in case of unsubscription. Here he will take up full 1000. Even if one single person doesn't come, he will take up the entire 1000. Getting my point? Okay. So for this particular service, they are paid underwriting commission. It is always paid on the issue price of the shares and debentures. Issue price. Okay, underwriting commission is paid at a specified rate, whatever is the decision, the rate which we decide, at the price of the whole of the shares or debentures underwritten. That is the gross liability. It is always paid on gross liability and on the issue price with the percentage of commission as decided. Okay, now percentage of commission as per law is limited to 5% on issue price of shares and 2.5% in case of debentures. The rates of commission given above are the maximum rates. You cannot go beyond this 5% and 2.5%. It can be below that. Okay, so these are the maximum rates, 5% on shares and 2.5% on the debentures. Okay. Now, as I told you that the underwriters, they do not have only the job of telling the company that, okay, you put the shares for issue, how many ever will come, fine, they will subscribe, the ones who are remaining, we will take it up. No, underwriters have got responsibility. They actively participate in this issue of shares. How? They also try to publicize this issue. They try to bring people or subscribers or or holders, the one who wants to subscribe, they try to bring the subscribers from their end. Okay, so whenever the company gets the subscriptions or the applications, they come to know that they have come from this particular underwriter because they have a marking. Okay, when you fill the application form as an investor, okay, or the subscriber, when they fill the application form, okay, if it is coming through that underwriter, it will have a marking on that. Marked applications it is known as. That means they are coming from or with the help of that underwriter, through that underwriter. And the balance are known as unmarked applications. There is no marking on that, that means they are coming directly. Okay, so marked applications are the ones which bear the stamp of that respective underwriter, and unmarked application has no such stamp. Okay. Now, if the entire issue is underwritten by single underwriter, all the marked applications, it will be from that single underwriter. And if it is from different underwriters, means you have appointed 2-3 underwriters because the issue is so big, so then the marked applications will be of that particular underwriter A, B, C. It will be amongst, you will be able to know that, okay, it has come from underwriter A, from B and from C. And then what will happen with unmarked applications? That we will see. Then we will divide the unmarked applications in the gross liability ratio. Why do we need to know this marked applications and unmarked applications? Because we have to reduce the liability of the we have to find out the liability of the underwriters. Only because the underwriter said that, okay, I am ready to subscribe to 80%. Okay, so then I will forcefully tell him that no, you take only now 80%. I will ascertain as a company that how many marked applications have been received, how many unmarked applications have been received, and whatever is the remaining balance, that I will tell the underwriter to take it up, right? I will pay him commission on the gross liability because that was the original agreement between the company and the underwriter. But to take up the shares, I will obviously, as a company, I will tell him that, okay, your net liability is only these many shares. Correct? So it is very important for us to know the net liability, and therefore we need to know the marked and unmarked applications. So how do we determine the liability of underwriters? One is in case of completely underwritten, full issue is underwritten, simple. Liability will be shares or debentures which were offered to public minus whatever applications are received. So whatever balance is left, that will be the liability of the underwriter in case of the underwriting when it is fully, completely underwritten. Okay. Now say if shares and debentures are oversubscribed or it is fully subscribed, then underwriter becomes free from his liability. Okay, and is not liable to take up any shares or debentures, but he will get the commission. Okay, important. Clear here? And if the underwriting is done in a agreed ratio, it is not fully underwritten. Okay, it is done in the agreed ratio by a number of underwriters. Okay, even if it is completely underwritten, but I have got some A, B, C, three underwriters, and they are taking up, or say only A and B. Okay, A and B, they are taking up this underwriting in equal ratio. So A has taken it up as 50% and B is taking up a 50%. Equal ratio. So then in that case, gross liability of every individual underwriter is agreed in the ratio first, that is reduced with the help of the marked applications. So say here whatever is the gross liability, 100 shares, and marked applications I got of 20 shares. Balance is left of 80. Then I will subtract the unmarked applications. Now if there was only one underwriter, I knew that the number of shares issued minus the applications received will become the liability of that one single underwriter. When there is more than one underwriter, no, then unmarked applications have to be divided amongst them in their gross liability ratio. We are supposed to give the credit of this unmarked applications to all the underwriters in their gross liability ratio. Okay, so say the unmarked applications, the ratio is equal. Unmarked applications total are 40. So since it is equal, A will get 20, B will get 20. And so now the net liability is 60 shares only. Okay, 60 shares only. Okay, at times what happens is the credit to unmarked application is given in the ratio of gross liability as reduced by the marked applications. Okay, in this case individual liability calculate will be little different. Now these different types of calculation I have done in my, you can go ahead and watch in my detailed lectures. Okay, that how when you can give the benefit or the credit of unmarked applications. Okay, in some cases it can happen that the liability of one underwriter has become negative. What does that mean? In fact the liability is not there only, it is going in minus. So then that negative balance, okay, you give the credit of that to the other underwriter so that his liability also reduces. Okay, it is done inter se in the accounts. Now in case of partial underwriting, what happens in case of partial underwriting? If the issue is underwritten by only one underwriter, then the net liability will be whatever is his gross liability. Say gross liability was 70% of the issue, 1000 was the issue, 70% means 700. Marked applications was received for 600 shares, so his net liability will only be 100. Okay, and if the part issue, okay, if it is the issue is done underwritten by more than one underwriter, okay, so in such a case part of the whole issue like 70% or 80% is underwritten by number of underwriters, then the balance 30% or 20% the company itself has to have underwritten the same. Okay, that is what I have already explained. Now firm underwriting. What is the meaning of firm underwriting? What happens is, as an underwriter, say today I am an underwriter. Okay, I am telling the public that subscribe, I am assessing the company. No, I am doing the underwriting of company ABC Limited. Okay, so basically I am helping the company in getting subscribers. Okay, I have helped the company to assess the price, to know their value in the market, etc. So if as an underwriter I am giving public my forms, okay, marked forms, and telling them that go and apply for the shares of this company, I myself also have to invest now something in that company. Only then I can tell others also to come in that organization, right? So firm underwriting is that the underwriters take up agreed number of shares for their own investment. Okay, so whenever I am computing the individual liability of the underwriter, that firm underwriting has to be taken into consideration. Okay, in order to find the net liability, I will remove that firm underwriting. But to find out the pure liability, okay, net liability, I will remove the firm underwritten also. But in order to find out the pure liability, I will add the firm underwritten. So then I will come to know that yes, underwriter has to pay me for his net liability plus the shares which he has taken up for his own investment. Okay, so now there are two things over here. When firm underwritten is treated at par with marked applications. Okay, same like we are treating it as a marked application. So what you will do is gross liability minus marked applications including the firm underwriting. If they have given you separately, so you will say gross liability minus marked applications minus firm underwritten. Okay, you will get a balance left. From that you will remove unmarked applications and you will get the net liability. To the net liability you will add the firm underwritten. You will get the total or the pure liability. Simple. First you will subtract the firm underwritten. From the gross liability, remove the marked applications, remove the firm underwritten. Both marked applications and firm underwritten are treated at par. Okay, same thing. Subtract, balance, and then you will get unmarked applications also. You will subtract, you will get net liability. Add firm underwritten, you will get the total liability. But sometimes, they say that treat the firm underwriting at par with unmarked applications. So then here a little bit changes. Here then what happens is, in case of when you treating the firm underwritten at par with unmarked applications. Okay, firm underwritten, you are treating it at par with unmarked applications. So then what you do is you add both of them. Total, first you add it, and then gross liability amount. From that you just subtract marked applications. You will get some balance. Okay. Then you will subtract unmarked applications. Your unmarked applications will be including firm underwriting. In previous it was including marked applications was including firm underwriting, no? In the previous one. Here when I am treating it as at par with unmarked applications including firm underwriting, what will happen is including firm underwriting. How do I treat my unmarked applications? I divide them by the help of gross liability ratio. Okay, so I will add them and then not take the actual amount of firm underwriting. I will take it as per the gross liability ratio. I'll get my net liability. And then I will add back actual firm underwritten. I'll get my total liability. Understanding? So this is going to be the difference when you are treating the firm underwritten at par with marked applications and when you are treating the firm underwritten at par with unmarked applications. Whenever you are treating it with marked applications, there is no problem. From gross liability minus marked minus firm underwritten, and then in the end again you add it back. But when you are treating it with unmarked applications, so at the time of subtracting them, add both and do it with the help of gross liability ratio. And when you add in the end, you take the actual firm underwritten shares, actual number of shares. Okay. Now accounting treatment relating to the shares and debentures underwriting. When shares and debentures are allotted to the underwriters as per the liability which we have ascertained, you will underwriters account debit to share capital or debentures, whatever is the issue. Okay. The commission, when commission becomes payable to the underwriters commission account debit to underwriters, and the net amount received. Now what happens is we generally don't actually pay the commission. We try to net it off. We have to take money from the underwriters on their liability and we have to pay them also. So we try to net that off. Whatever is the balance, either the company will pay or receive it. So see, when the net amount from the underwriters on the shares or debentures is taken up, then the company will do bank account debit to underwriters. Therefore, generally, underwriters' commission is not paid in cash. It is adjusted on the money which is due on the shares and debentures underwritten by the underwriters. Clear, everyone? We will solve one illustration to get you more understanding. Okay, then you can again read the theory. Now see, Lilies Limited, they have issued 1 lakh equity shares where the issue was underwritten by 3 underwriters. Okay, so 40%, 30%, 30%. Total ho gaya 100%. That means it is fully underwritten, completely underwritten. Though there are 3 different underwriters. Completely underwritten. Understood this now? What I am talking about, complete underwriting. Now, out of this 1 lakh equity shares, application for 60,000 shares were received in all, out of which 20,000 shares were bearing stamp of A, 10,000 shares were bearing stamp of B, and 20,000 of C. The remaining applications for 10,000 shares did not bear any stamp. Okay, 60,000 shares were received in all out of 1 lakh. And out of that, marked applications is 20 of A, 10 of B, and 20 of C. Okay, this also comes up to 50. And 10,000 is unmarked applications, 10,000 unmarked. So we have to find the liability of the underwriters. There is no firm underwritten. If it is not given, nothing we will do about it. So now the net liability, A, B and C, they have a specific ratio, 40%, 30%, 30%. So this 1 lakh shares, I will divide in their gross liability ratio. Okay, gross liability ratio. So 40,000, 30,000, 30,000. Less marked applications it is given. So I will subtract 20, 10 of B and 20 of C. So balance is left here. Unmarked applications is also given 10,000. That I will divide in the gross liability ratio. 40,000 for A. So 4,000, 40%, sorry. 30% of B and 30% of C. So the net liability of my underwriters, from A, I will have to take money on 16,000 shares, 17,000 shares and 7,000 of C. Easy, clear, understood? Slowly you will understand all the concept which I explained in the theory. Okay. So your theory will not be difficult even if they have asked you to write a note on it. Come on. Question number 2. Now see this. Ramona Limited, they have issued 50,000 equity shares of which only 60% was underwritten by Green. Now there is only one underwriter, Green, only one underwriter. Correct? Only one underwriter. And 60% was taken up. That means it is partially underwritten. Applications for 45,000 shares were received in all, out of which applications of 26,000 shares were marked. So it will be marked with green only, no one underwriter is there. So I have to determine the liability of Green. So simple. I will take the gross liability. Gross liability here will be only 60% of 50,000, 30,000 shares. That means for balance 20,000 shares, company itself is the underwriter. Okay, less marked applications 26,000. Net liability of green is 4,000 shares. Clear? Now say suppose the marked applications of green came 30,000 or more, then green will have not got only any liability. Okay. Say suppose the applications received by the company been for all 50,000 shares, green would have no liability at all, even though the marked applications is 26,000. If the company would have received total 50,000, then also liability of green would become 0, though she had taken up underwriting of 60%. Okay. And say suppose applications received by the company was 48,000 share, then green liabilities will be restricted only to 2,000. Only one underwriter is there, though she has underwritten to 60%, okay, which is 30,000. But company to got no 48,000 applications, so her liability will be limited only to 2,000 shares. Then nothing has to be done then with her marked applications. Okay. So in case the marked and unmarked applications is not to be given in the question, then one can assume the number of applications received as marked and as proportionate to the part of issue underwriting as received through the underwriter. So whatever number of applications received, you can treat that as marked applications if nothing is given in the question. Okay. Now see illustration number 3. ABC Limited issued 30,000 6% debentures of ₹100 each. 60% of the issue was underwritten by Delton. One underwriter partially underwritten to the extent of 60%. Applications were received for 28,000 debentures. Determine the liability. So gross liability will be 60% of 30,000. Okay. Now applications were received of 28,000. Did they tell you they were marked, not marked, what it is? No, na. So you can directly take it marked applications at 60% of the 28,000. I am giving the benefit of marked applications in the gross liability ratio. That is 60% of 28,000. So now net liability of Delton will be 1,200 debentures. The other way of solving it is simple. 30,000 debentures were issued. 28,000 applications were received. Only one underwriter is there. So 2,000. 60% is only underwritten. So 1,200. Simple. Right. 30,000 was issued. 20,000 applications was received. 2,000 is remaining. Underwriting is only to the extent of 60%. So 1,200 shares is the debentures is the liability of Mr. Delton. Okay. Come on. Now the illustration number 4. Binsar Limited issued 12% 10,000 preference shares of ₹10 each. The issue was underwritten as follows. Apple 30%, mango 30%, orange 20%. Applications for 8,000 shares were received by the company in all. Determine the liability of the respective underwriter. Now they have not told me that the applications which were marked in so and so amount for A, B, apple, mango, orange. So what I will do is simple. Gross liability I know. 10,000 preference shares. I will take it as per gross liability. 3,000, 3,000, 2,000. Right? Applications were received for 8,000. That also I will divide it in the gross liability ratio. Simple. Net liability will be 600 of apple, 600 of mango and 400 of orange. If like this, if you can also do an alternative way of solving, I like this table format the best way. Alternate way is from 10,000 you have received 8,000. So your unsubscribed shares are only 2000, no? From 10, 8000 you have received. So unsubscribed is 2000. Divide them in their gross liability ratio of 30, 30 and 20. So total liability will be 1600 shares. Okay, it is not even completely underwritten. If you see 30, 30, 60 plus 20, it is only 80% of underwriting is being done. That means 20% of this 2000. Okay, 20%. That is 400 shares will remain unissued. Because only 80% is underwritten, no? So from this 2000, 80% I will get it from my underwriters in their ratio. But 400 will remain unissued. Clear here? Anybody, any doubt you all have now so far before I move to multiple choice question? Everybody is okay now? Can I move ahead and then we'll finish it with the multiple choice question? They're very simple. Okay, I am doing this multiple choice question, but they are also to be solved. Some theory and some which require solving. Underwriting commission is always paid on the issue price. Maximum allowed is 5% on shares and it is 2.5% on debentures. Just revising. Unmarked application is always distributed to all the underwriters in their gross liability ratio. Okay. A company incorporated on 1st January 2019 issued a prospectus inviting 1 lakh equity shares of 10 each. The whole issue was fully underwritten by 2 underwriters equally. Applications were received for 90,000 shares, of which marked applications were as follows: A and B. Find out the liability of each underwriter individually. So A and B, their gross liability is 50%, 50% underwritten equally, fully underwritten. So it is going to be 50,000, 50,000. Okay, 50%, 50%. Minus marked applications, they have already given me 35,000, 45,000. So balance left will be 15 and here it will be 5,000. Less unmarked applications in the gross liability ratio. How many unmarked applications are there? Applications were received for 90,000 of shares which were marked. Correct. Question is saying what? Applications were received for 90,000 shares, of which marked application is 35 and 45. So 35,000 plus 45,000. 80,000. So how much is the unmarked application? From 90,000 I will subtract 80,000. Total applications received is 90. From that marked they have given me. So my unmarked will be 10,000. So that 10,000 I will divide in their gross liability ratio. So liability of B is nil and of A it is 10,000. This balance 10,000 of unmarked application I will divide it in the gross liability ratio. This is the answer. Clear? Question number 4. Now there are 4 underwriters. See A, B, C, D. Same, inviting applications for 10 lakh equity shares. Equity shares, this issue was fully underwritten by 4 underwriters equally. Applications were received for 9 lakh shares, of which marked applications were as follows. Find out the liability of each underwriter individually. Come on, quickly solve this. Now, make 4 columns A, B, C, D. Write down their gross liability on this total. 10 lakhs equally, no? So 2,50,000 it will be gross liability of each underwriter. Marked applications is given. Find out the unmarked applications. With the help of this, divide that in the gross liability ratio. You will get the net liability. Quickly give me the answer. The answer I know it is 45. Give me the answer for unmarked applications. And when you divide them in the gross liability ratio, what it is? A, B, C and D. Come on. How much is the net liability of A? Or give me the answer for unmarked applications divided by gross liability. Solved? I am not solving this sum. You all are going to give me the answer only, then I will solve the sum. Even if it is wrong, it is not a problem. At least I want you all to try. Tell me the gross liability ratio for unmarked applications. See, gross liability ratio is equal. So unmarked applications also will be divided equally. How much is the unmarked applications? This is my simple question. Fantastic. Unmarked application is 1 lakh. If I'll divide that from amongst all the underwriters A, B, C, D, 25,000 each. So what will be my net liability? Anybody's liability is coming 0. Net liability for A is 20,000, B is 0, C is minus. Oh my god, no. Seriously? Simple subtraction you all have to do. My dear friends, simple subtraction. Chalo, I will only solve it. It is A, B, C and D. Gross liability for 1 lakh. No, sorry. How many lakh shares? 10 lakh shares. Na? So 2 lakh 50. 2 lakh 50. 2 lakh 50 for C. 2 lakh 50,000 for D. Minus marked applications, which is already given in the problem. 1 lakh 80,000. Then they have given you 2 lakhs for B. Then 2 lakh 25,000 for C. And 1 lakh 95,000 for D. So what is the balance left? Balance left is 70,000 for A, 50,000 for B, 25,000 for C, and D is left with 55,000 balance. Okay. Minus unmarked applications to be divided in the gross liability ratio. Now, how much is the unmarked applications? From the question only it can be understood, no? Applications were received for 9 lakh shares, out of which marked were this much. When I will add up all the marked applications, it comes up to 8 lakhs. But applications were received for 9 lakh shares. That means 1 lakh shares are unmarked. Unmarked applications I will divide in the gross liability ratio. So 1 lakh, when I'll divide 25,000 each. I don't know what you all have done that you all are getting such wrong answer. Wrong to the extent that not even one mistake here and there. Everything is wrong. So here it is going to be 45,000 A. 25,000 will be the net liability of B. C will have zero liability, and here it is going to be 30,000 for D. This is the answer. 45, 25, 0 and 30. I have no clue as to what you all have done, that you all have not subtracted properly, or what. Why have you all not got this answer? Please check it again. Okay. Now the next and the last question of this chapter. A company offered 2,50,000 equity shares to public for subscription. 70% of public issue was underwritten by G. Her firm underwriting was for 40,000 shares. Public subscribed for 1,30,000 shares. What is the net liability of G if, as per the underwriting agreement, no credit is given to underwriter G for her firm underwritten shares? Okay, so basically gross liability, it is going to be 70% of 2,50,000 shares. So that is going to be 1,75,000 shares. Okay, now public subscribed for 1,30,000 shares. So 1,30,000 shares into 70%, I can take that as marked applications. Okay, that will be 91,000 marked applications. Then minus firm underwritten, $40,000. Okay, so what will be the balance? 1,75,000 minus 91,000 minus 40,000. So balance left is 44,000. Balance. Okay, here we have to add back the firm underwritten. Okay, no, sorry, since there is only one underwriter, I am just changing this small thing. There is only one underwriter, no? So to the extent of the shares which have been subscribed to, okay, public has subscribed for 1,30,000 shares, no? So the gross liability being 1,75,000 less the subscription received, I will remove that completely, no? 1,30,000. So that will come to 45,000. right, minus firm underwritten. Firm underwritten, they are saying no credit is to be given. So first, when I will remove the firm underwritten, I will take 40,000 into 70%. Okay, so that will come to 28,000. When I will subtract, I am going to get 17,000. In 17,000, this is going to be the net liability. Add back the firm underwritten, it is going to be the total liability, 57,000. This is 57,000 shares. Okay, firm total liability of that Mr. Okay, this is going to be the answer because there is only one underwriter. Okay, everybody, anything you all have to ask? Any question? So that is it with the underwriting of shares. Okay, even if you all will revise this much which I have done right now for underwriting, underwriting is asked for like 5 marks. Okay, so maximum 5 marks. So even if you know this much, it is more than enough. Okay, so thank you everyone. I will be seeing you again next time for another marathon of corporate accounting. Okay, till then revise and practice and try to do the sums from my dream batch also. Okay, so bye everyone, all the best.